Hi, welcome to this special YouTube class on Unacademy platform. Today, as part of our discussions, we will be looking at inflation and banking sectors. We will be looking at two important topics from your Indian economy, prelims point of view. Those topics are inflation and banking. So, yesterday we have seen monetary policy. We also have seen the different aspects related to monetary policy. We have seen liquidity trap. We have seen quantitative easing, and we can be looking at this stabilization. This stabilization is done by Reserve Bank of India to control the prices because of its operations related to related to external sector. Let us proceed further and look at what we call this banking system in India. Let us look at banking sector in India. What is this banking? And we will also look at what are the problems with India's banking system. We also look at what kind of reforms the government of India has implemented in recent times. Then we will see what else should be done to make our banking sector much more effective. Before looking at all those things, let us start with what we call the functions of a bank. What is a bank? We simply say that a bank is a financial institution that attracts deposits, and on the basis of those deposits, it gives loans to the customers. While attracting the deposits, bank will offer certain rate of interest to the customers, and while giving the loans, it will also take certain rate of interest from again the customers. And the interest rate difference is the profit for any bank. The rate of interest, the difference between the lending rates and the deposit rates is the profit for banks. For example, if we are depositing our money in the banks on savings account, we get around 4%. On the other hand, if I am taking a loan from the bank might charge me around 10%. The difference between this 10% and 4%, which is what we call the profit for a bank. These banks, as we say, these banks are the ones that run the financial system of any country. We will know about the financial strength of any country in terms of the functioning of its banking system. And there are so many diversified arguments here. In a country like United States of America, there are hundreds of banks, whereas in India we have only very few number of banks. And it is said that we also need to have more banks. But in recent times, what we are witnessing is going in the reverse direction, wherein the government of India had opted for merger of different banks because we wanted to have mega banks. That is what we say. Proceeding further, what do we say is that these banks will be working under the control and guidance of the central bank of any country called in India Reserve Bank of India. Reserve Bank of India will control the functioning of these banks through various measures as we discussed the other day, through bank rate, through open market operations, through these reverse repo rates, and then these CRR and SLR. These are all the instruments. Now let us proceed further and look at what are the different types of banks that we have. We have broadly what we call them as a scheduled banks. We have scheduled banks. And what are these scheduled banks? These scheduled banks are the ones which are part of the schedule of Reserve Bank of India. Reserve Bank of India Banking Regulation Act 1949. These banks are recognized as scheduled banks, and we can call them as scheduled commercial banks also. And what is the qualification that is necessary for a bank to be recognized as a scheduled commercial bank by Reserve Bank of India. First one is the paid up capital of the bank should not be less than 5 lakh rupees. Second, they must satisfy all the rules and regulations that the Reserve Bank of India has to protect the interests of the consumers. And these two are the conditions that are needed for a bank to be called a scheduled bank. In India, we have public sector banks, we have private banks, we have we have these regional rural banks, we have lead banks, we have investment banks, we have different types of these banks. So let us look at all these banks. Public sector banks, as the name itself indicates, are under the direct control and supervision of the Government of India, and they are owned by the Government of India. Their assets are owned by the Government of India, public sector banks. Then we have development banks. In 1960s, the Government of India had come out with this concept of development banks, or you can call them as development financial institutions. We had IDBI, Industrial Development Bank of India. We had ICICI, Industrial Credit and Investment Corporation of India. We had IFCI, Industrial Financial Corporation of India, and we had this Export Import Bank of India. Then we had National Housing Bank. Then we have still NABARD, National Bank for Agriculture and Rural Development. What you must remember here is that from the prelims point of view, UPSC is asking questions from these banks. For example, last year in our preliminary examination, the questions were asked about about NABARD. So I expect you to go through all the facts related to these banks. I want you to go through all the facts related to all these banks. There is no point in talking about all of them now. Then we had at the time of independence so many private sector banks. The Government of India had decided to nationalize those banks. In 1969, the Government of India had nationalized around 14 private sector banks. In 1980, it has again nationalized another. It has again nationalized another 6 banks. Altogether, 20 banks were nationalized by the Government of India. Then, after that, the Government of India, as I mentioned, had come out with other banks like regional rural banks, and it had also come out with banks for specific sectors and specific areas. Let us proceed and look at all of them. So, these public sector banks, these public sector banks and commercial banks, what do? They, as I said, provide the loans, and they also attract deposits. As we know, the basic problem with the banking in India was that there is a penetration of banks, especially in rural areas, was always a major issue. That was the reason why in 1969 the Government of India had decided to nationalize these private sector banks, because these private sector banks were having most of their operations in only urban areas, and they had their operations mostly catering into middle class and industrial customers. They were not providing services to people in rural areas. They were not providing services to agriculture. They were not providing services to other small scale industries. In order to satisfy all these socialistic objectives, the then Prime Minister had decided to nationalize these banks, to improve banking sector penetration, to provide more loans to socially and economically backward sections of society. And we had, the State Bank of India. The State Bank of India had emerged as one of the major banks at that point of time, with so many associates. It had so many 5 different associates, and after that, the next step taken by the Government of India, apart from nationalization of banks, was the setting up of what we call regional rural banks. Again, the questions are repeatedly asked in our preliminary examination about these regional rural banks. As I said, in 1975, the then Prime Minister had decided that India would become a socialistic economy. It was included in our constitution also. In order to realize those objectives, the government had come out with this regional rural banks with the objective of ensuring financial inclusion. These regional rural banks had come up on 2nd October 1975. At that point of time, there were only 5 regional rural banks, and they were set up in rural areas of the country to provide banking services to poor and vulnerable sections of our society. We study in development in dynamics, in developmental economics. The government of India had adopted 2 different approaches to tackle poverty. One is area-based approach. Second one is in a target-based approach. As part of this area-based approach, the government of India had come out with this regional rural banks. They wanted to target the rural areas, and they wanted to target the poor and vulnerable sections of society in rural areas. What is the objective of these regional rural banks? Please, as I said, all these questions are repeatedly asked in our prelims. They look sometimes boring, but that is what UPSC examination is all about. You have to remember all the facts. They will say which among the following is not true about regional rural banks in India. So you should be knowing all of them. So then what happened? Then the government of India had come up with specific objectives related to regional rural banks. It has said that they must provide credit to weaker sections of society at concessional rates of interest. At concessional rates of interest. That means they must be provided credit at discounted rates of interest because they cannot afford the high rates of interest that these commercial banks and other public sector banks charge. They simply cannot afford. This is what we call equity. Second, another important objective of these regional rural banks was to basically ensure that they will mobilize the rural savings, and the money can be used for productive activities in rural areas. The money can be used for productive activities, and more importantly, the personnel working in these regional rural banks can be a better human resource for other commercial banks in that particular area because of their proximity to the people there, because of their knowledge of conditions at the local level, and because of their ability to expand the banking activities in those areas. This is what the government of India had said, and after 1987, the government of India had decided to stop, coming up with new regional rural banks, and at this point of time, we have around 196 regional rural banks, out of which 171 are running in losses. That is what we have to remember. Most of them are running in losses. What is the reason why they are running in losses? Because of the fact that these rural banks were not expected to make profits. They were expected to serve these weaker sections of society, both socially and economically weaker sections of society. Profit was not on their radar. Then that is when the government of India had realized that this cannot go on forever, because when these banks are incurring so much of losses, it will be adding more to the exchequer in terms of expenditure. That is when it was decided that these regional rural banks also will charge the same kind of rate of interest that commercial banks charge, so that they can cut down their losses. This is one of the important reforms the government of India has had implemented. Second important reform they have implemented in regional rural banks was the government of India had decided that these regional rural banks will not only be providing loans to weaker sections of society, they would be providing loans to each and every section of society so that they can expand their banking activities also. So these regional rural banks, as you can see here, these regional rural banks ultimately could not achieve most of their objectives because of the fact that there was so much of corruption, and because of the fact that they were not efficient in terms of their activities. Then the government of India had come out with another instrument called the lead bank scheme? Again, this question was asked, if I am not wrong, last year in our main examination. This was asked last year. Last year or before last year, I don't exactly remember, but it was asked. The government of India had come out with this lead bank scheme in 1969. And what is this lead bank scheme? What are the important features of this lead bank scheme that the government of India had come out with? Again, as I mentioned, the government of India had opted for this area-based approach and target-based approach to tackle poverty. And this lead bank scheme is part of this area-based approach. And what is this lead bank scheme? This was recommended by Godgill's group on the banking sector reforms, and it has said that one bank in a particular district will be identified as the lead bank of that district. Please remember, under this lead bank scheme, the government will not be setting up any new banks. It will not be coming out with new branches. It will not be setting up any new banks like regional rural banks. The government of India, what it is doing is that, as part of this lead bank scheme, in all the districts of the country, in each and every district, one bank will be identified as a lead bank in that particular district. And what is that lead bank? In one district it can be SBI, in another district it can be IDBI, in another district it can be another bank. Like that, the government would identify one lead bank in each and every district. Then after that, this lead bank, what it is expected to do? This lead bank is expected to ensure coordination between the banks of that area and also between the government and other stakeholders. That is what it is expected to do. Ensure coordination between the government, other banks in that particular area, and other stakeholders in that particular area. And they will also, this lead bank also will, look at the annual district credit plans of the district and make sure that those credit plans of the district are transformed into reality by coming out with recommendations to other banks with regard to their loan schemes. For example, in a district there are around, say, 10 banks are there, out of which one bank will be considered as a lead bank, and this lead bank will ensure coordination between all the other banks and along with the government, and it makes sure that all the schemes of the government are implemented by these banks in a more effective manner. It makes sure that all these other banks in that district would achieve the credit targets that the government of India had prescribed for those banks. And it also helps in synchronizing the effects of all those banks. This is what we call the lead bank scheme. This was introduced. Please remember, when we talk about lead bank, it is not about setting up a new bank. It is not about coming out with a new branch. It is all about looking at what exactly is there in terms of infrastructure and utilizing that infrastructure in a better manner by ensuring coordination between the various banks that are there, that are existing in that particular district. This lead bank scheme was what the government of India had come up with in 1969 as part of area-based approach to development. So you can see here, if you look at the banking system in India, we have the public sector banks, then we have the developmental banks, or you can say that we had, the developmental banks. Then we had, still we have regional rural banks. Then we have these lead banks. That is how we can say, horizontally, all of them will be performing their functions. Along with that, we had, the government of India, as I have said, nationalized 14 banks in 1969 and 6 more banks in 1980, with the objective of, ensuring a socialistic pattern of society, so that banks would provide more loans to the people in rural areas, to socially and economically backward sections of society. And apart from that, we also had this NABARD, National Bank for Agriculture and Rural Development, also to provide loans to mostly for agricultural activities and other related activities in rural areas. So this is what we say the structure of a banking sector in India. Now, after 1991, what we have done is what we have to look at. You know, lead bank will always be a public sector bank. You know, please remember, in those days, mostly all the banks were in the public sector only. You know, when Government of India had nationalized 20 private sector banks, most of the banks were only in the public sector. The lead bank in the district will only be in the public sector, right? It will be only in the public sector. So, and the Government of India had come out with this kind of banking system from 1950s to 1990s. Now, if you look at the analytical part, these are all the factual aspects. Then look at the analytical part. Did our banking system achieve whatever the targets it had set for itself in 1950s? Did they realize all the objectives? When we talk about the performance, obviously we have to say that they could not. What were the problems that the banking sector faced by 1990s? When the government nationalized all the banks with the noble objective of ensuring equity in the development process, to provide loans to weaker sections of society in rural areas, to expand banking activities in rural areas. These were done with noble intentions, but unfortunately, what happened was, the performance was anything, the performance was anything that can be, resembling the objectives. This banking sector in India was full of corruption. Most of the banks were headed by, especially these regional rural banks. We had also these cooperative banks, district credit cooperative societies, right? So we have also had these cooperative banks, and all of them combined together. What happened was politicization of the entire banking system. The loans were mostly provided to unworthy beneficiaries, mostly the relatives and the friends of politicians. There was what we call in those days crony socialism, CRONY, crony socialism. This unholy nexus between the politicians and the bureaucracy and the businessmen in the name of socialism. The loans were never provided to the weaker sections of society. Loans were never provided to weaker sections of society. And the bank penetration was also almost nil in rural areas, in spite of the fact that one of the most important objectives of this nationalization was to ensure universal banking. By 1990s, our financial system was in complete doldrums. In till between 1950s and 1990s, as we study in our economy, what we say is that between 1950s and 1990s, India was a high-cost economy. High-cost economy. What do you mean by high-cost economy? The interest rates were very high. In the name of socialism, what did the government do? In the name of socialism, the government offered very high rates of interest on the deposits to make people deposit money with the bank. They offered very high rates of interest. The interest rate on savings account was 10%, 12%. It was very high. If you are offering such high rates of interest on savings accounts, what happens? You have to charge much higher rate of interest to recover your cost of interest, cost of savings. So the lending rates were also very high, 18%. The lending rates were also very high, 18%. Obviously, the rate of interest was very high. As we study in our monetary policy, there is inverse relationship between rate of interest and the demand for investment funds. Since the rate of interest was very high, the demand for investment funds was also very low. On top of it, in these first 40 years of our independence, our stock market was also not very vibrant. So businessmen mostly depended on the loans provided by the banks. And the banks did not have much of money to provide loans. Why? Because what the regional banks did not have much of money to provide loans, because they could not attract more deposits from the people. Why they could not attract more deposits from the people? The banks, in spite of the fact that they were nationalized to expand the banking sector in India, they focused mostly on urban areas and cities. They simply did not have enough number of bank branches in rural areas. On the other hand, these regional rural banks and cooperative credit societies had become very, very corrupt because of complete secrecy in the banking system. So by 1991, Indian economy, as we discussed, had collapsed because of the weaknesses in the banking system. On top of it, as I mentioned, RBI could not follow an independent monetary policy. RBI was always asked by the central government to finance the deficits of the government, what we call it as deficit financing or budgetary deficits. So RBI could not realize the objective of reducing inflation also. India was a high cost economy and also with very high levels of price, very high prices. So the banking sector, in spite of the fact that the government had come out with so many institutions, could not cater to the needs of the people. So after 1991, when the country faced such a severe crisis, when the country faced such a severe crisis after 1991, the government was forced. The government was forced to what we call adopt a different policy related to the banking sector. And what was the policy the government had adopted after 1991? The government had opened up the banking sector to other private sector banks, and also the government allowed the foreign banks to set up their subsidiaries in India. And after 1991, the government also opted for globalization. So what was the consequence of all these things? The consequence of all these things was that there was rapid expansion of banking sector, especially private commercial banks went on aggressive opening up of branches, and definitely this this activity of banking services being provided to vast sections of society could be realized at least in urban areas of the country. And another problem with our banking system was this banking system was crippled through both the supply side bottlenecks and demand side bottlenecks. On the supply side bottlenecks, as we say here, the banking sector was suffering from various kinds of limitations. First and foremost, in those days, between 1950s and 1990s, the banks could not lend as much money as they would want to the customers in spite of having good amount of money deposits with them. Why? Because CRR was very high, cash reserve ratio. SLR was also very high. Let me give you one simple example to explain these bottlenecks. For example, a bank has attracted a deposit of 100 rupees. A bank has attracted a deposit of 100 rupees. Can they give those 100 rupees as loans? Can the bank give those 100 rupees as loans? Obviously not. In those days, CRR was very high, around 12%, 13%. That means out of 100 rupees, 12, 13 rupees will go for CRR. 12 to 13 rupees will go for CRR. Then SLR also was very high. Statutory liquidity ratio, it was also very high. It was around, say, 25%. 25%, sometimes 30% also, statutory liquidity ratio. So, SLR, let us assume to be around 25% or even 30%. Sometimes it was 35% also. So, 30% of SLR. That means the 30 rupees will go for SLR. 12 rupees CRR, 30 rupees SLR, 42 rupees are gone here. They cannot give loans. Remaining 58 rupees. In remaining 58 rupees, we had what is this called PSL. Reserve Bank of India had come out with, the Government of India had come out with this PSL. What is this PSL? Priority sector lending. Priority sector lending. So 40% of the deposits given by the banks should be given only to the priority sector. The private sector identified the government was agriculture, and later the government has added some other small scale industries also. But private sector was mostly only agriculture. So in the remaining 58 rupees, 40% has to go only to what we call agriculture, priority sector lending. So what is the amount of money left with the banks out of 100 rupees to be given as loans to the industrial sector, where they can charge a good high rate of interest also. As part of this priority sector lending, the banks will have to provide loans to the agriculture sector at the discounted rates of interest. What is called DRI, discounted rate of interest. You have to provide the loans to the agriculture sector at around 6% rate of interest. And you are attracting deposits at around 12% rate of interest, and you are charging only 6% rate of interest, because of which you will always be incurring losses. Simple mathematics will tell you that you will be incurring huge amount of losses even after giving the loans also. So then what happened? The actual amount of money that the banks will have to be with themselves to give as loans to the industrial sector was around 36 rupees out of 100. Is it possible for them to earn profits by giving loans only to the tune of 36 rupees out of 100 rupees of deposits? Right? These are all this what we call the supply side bottlenecks our banks have faced. Please remember, all of them can be asked as questions in our preliminary examination. All of them can be asked as questions. So the banks always started with losses, always functioned with losses, always ended up with losses only, because of the socialistic objectives of the government. Socialistic objectives of the government. So banks had to bear most of the losses thanks to the socialistic objectives of the government. After 1991, as I have mentioned, after 1991, the government had decided that they would liberalize the banking system. And RBI also has decided that they would mostly focus on regulating the activities of the banks rather than directly controlling them. The major change that had taken place after 1991 was RBI depended more on what we call indirect methods of controlling the banking sector. Before 1991, RBI depended more on the direct methods to control the functioning of the banking sector. What are the direct methods and what are the indirect methods? Direct methods are this bank rate, as we study the means of monetary policy. One is bank rate, second one is CRR, third one is SLR. Before 1991, RBI had opted for bank rate, SLR and CRR to control the functioning of the banks. After 1991, RBI had opted for indirect methods. What are the indirect methods that we are talking about here? Open market operations, the repo rates and the reverse repo rates, and moralization. Instead of directly controlling their activities, physically controlling their activities, RBI started depending more on indirect methods to influence the functioning of banking system. And in case of priority sector lending, the Indian banks were expected to give 40% of their loans to the priority sector, whereas foreign banks were expected to lend 32% of the loans. What did the government do? What they have done is that they have not removed this priority sector lending. They have not removed this priority sector lending. What the government has done? The government has expanded the priority sector to include so many other sectors, not only agriculture, medium MSMEs, even sometimes even some basic infrastructure also was included in the private sector. Exports are also included in the priority sector, so that almost everything becomes a priority sector, so that it will not be problematic for the banks. On top of it, another major change that had taken place after 1991 was that thanks to the coming up of many private sector banks as well as foreign banks, what happened was we also had seen the development of the stock markets. Suddenly the banking sector was full of funds. Banks were flush with funds. Why? Because the banks were able to attract more deposits from the public by opening more branches in Type 2 and Type 3 cities, even in rural areas also. Obviously, when they open more branches, automatically they will have more deposits also. Yes, yes. Now as the government keep on expanding the private sector. Now even the startups are also part of the private sector. The government did not remove priority sector. What the government has done is that the government has made priority sector completely insignificant by expanding every activity in the priority sector. Every activity that is performed in the priority sector. The only activities that are not included in the priority sector nowadays are terrorism and Naxalism. Rest of everything is part of priority sector, right? So they are priority for those sections of society, not for everyone, right? Otherwise, everything is now part of a priority sector, so that they can also avail of these discounted rates of interest. So what happened is that after liberalization, after liberalization and globalization and privatization of 1991, suddenly the banks could attract a more amount of deposits, and they could also attract, they could also expand their branches into rural areas also. Because of which, what happened? They could afford to give more loans also. And another thing that the government had taken as part of 1997 monetary policy was the government stopped this deficit financing also. No longer the deficit in the budgets would be financed by Reserve Bank of India by printing currency, so that inflation can also be under control. Interest rates also will be less. When you have more amount of money coming into the system, automatically the interest rates also would come down. That is what exactly happened after 1991. Right now, our interest rates are comparable with interest rates in other, at least developing countries around the world, so that we can also become competitive in the global financial systems. So then what happened? On the other hand, the government has encouraged the banks to be more aggressive. The government has encouraged banks to be more aggressive in terms of giving loans also, with the help of what is called, we have witnessed this e-banking, computerization of their operations. It has made much more easier e-deposits also. These are all the things that they can be asked e-deposits also. For example, you don't have to print a real currency. You can just deposit the amount into the branch of that particular bank. RBI can deposit the money without printing currency also. It becomes much more easier to create a currency. As we know, in our monetary system, you can create currency by printing the currency, or by the commercial banks through these check facilities. Thanks to this e-banking system and e-deposits, what we are able to do is that we are able to create this money supply in the economy in a much more easier manner, so that banks will not be in a position to look for funds to give loans. So banks nowadays are able to give at least 200% of their deposits also as loans. The rate of interest also had come down, and the banks are having a lot of competition among themselves, because of which the loan rates also had come down drastically. These are all the positive consequences of liberalization, privatization, as well as globalization. But negatively, the banking system in India has suffered a lot after 1991. Why? The basic weaknesses of our banking system after 1991 could be traced to what happened in 1970s as part of socialism. When the government had nationalized the banks in the name of socialism, it only led to what we call systematic corruption. The government, it was believed, that would be able to differentiate between what we call the ownership and the management of public sector banks. Government would be owning the public sector banks, and the management would be given to the professionals, the directors of public sector banks. But it was never done in reality. Most of these public sector banks were treated as the personal fiefdoms of the finance ministers and the bureaucrats working in the finance ministry. The board of directors, who were appointed as board of directors, mostly the ruling political party members would be appointed as board of directors and chairmen of the public sector banks. And what they have done, they had given huge amount of loans. And if you look at it, again, we have to look at the entire financial system. After 1991, the country started experiencing rapid economic growth rates. The growth rate almost had reached 9% by 2004. Indian economy was growing at a record levels up to 9%, which was completely unheard of before 1991. Before 1991, we had only what is called Hindu rate of growth. So in 2004, after the UPA government came to power, they wanted to ensure that this growth rate is sustained for a longer period of time. So the then finance minister has encouraged the public sector banks to give more loans to industrial sector and infrastructure sectors. And they were asked to overlook collateral securities also while giving loans. They were asked to overlook the collateral securities also while giving loans. Yes, yes, Preeti, this e-banks can help in more better circulation of money in economics. We call it as velocity of circulation of money. It can help in better circulation of money because you don't have to print currency. You don't have to do anything. For example, if I am taking a loan, the bank will not give me the money. The money will be transferred to my account, and I will be transferring the money, same money to in the other account. And similarly, RBI also can transfer money into the accounts of banks so that banks can give more loans also. You are not creating any currency. E-banking system and e-deposits can play a revolutionary role in expanding the banking sector. But as I said, this rapid expansion of the banking sector was not without problems associated with it. So the then finance minister in the UPA government had asked the public sector banks to be aggressive in terms of giving loans to the infrastructure sector and industrial sector to ensure the rapid economic growth rate, 9% growth rate. And banks were asked to overlook this collateral security arrangements also. Normally, whenever a bank is giving a loan, it always looks for collateral security so that they would be able to recover those loans. Yes, Narayanan, your arguments are completely true. Will it not create problems of virtual currency and will it not lead to inflation? Even this virtual currency is a reality of life that we have to remember. You take the case of cryptocurrencies and bitcoins. They are also virtual currency. That is what you have to remember, right? Will does it result in inflation? Obviously not. The system will absorb this virtual currency over a period of time. So that is the reason when in India also it is not resulting in what we call inflation. In India we do not have what is called demand pull inflation. What we have right now is only cost push inflation. So this e-deposits is always a very good way of expanding your financial sector, banking sector, right? Will it result in inflation? It is not. It is unlikely to result in high levels of inflation, right? So coming back here, as I said, when our banking sector was expanding rapidly, this is where we also committed big mistakes, big blunders. We have given too much of freedom to these public sector banks without ensuring efficiency and accountability. These public sector banks, even after liberalization, were always controlled by the politicians. And what they have done is that they have overlooked this collateral security arrangements. The loans were given to the industrialists on the basis of their so-called projects, DPR, what we call it as DPR, detailed project reports. These industrialists will come out with very fancy estimates regarding the revenues that they are going to generate from the assets that they are creating. And most of the time, these estimates that they are coming out with do not have any what we call rational or logical basis. That is the reason why we talk about Basel norms also later. There are so many operational risks that are involved with these kind of loans. A bank cannot get profits unless it gives more loans. But when the bank is giving loans, it must also look for safety and security. And our banking system during this early part of our 2000s, the 21st century, has failed to ensure this critical balance between profitability versus safety. So the banks, what they have done, they started giving huge amount of loans without having those collateral securities on the basis of the so-called DPRs. And they did not ensure any safety and security mechanisms to recover the loans because there were no assets that were put as a collateral security by the so-called entrepreneurs. There were no assets, and these banks simply never really bothered to have those assets also as collateral security. And what happened? 2008 global financial crisis led to negative consequences on Indian economy also. In India, initially we thought that India was decoupled from this global financial crisis thanks to the robust domestic economy we had, which proved to be a completely wrong assumption. And our banking sector by 2012 was suffering from very huge amount of NPAs, non-performing assets. All those loans that were given during that period between the period between 2003 and 2012, 2004 and 2012 turned out to be non-performing assets. All those loans turned out to be non-performing assets, and banks were facing severe identity crisis. They were facing severe identity crisis, especially public sector banks in India. Public sector banks in general have more NPAs than private sector banks, thanks to inefficient management of public sector banks. It does not mean that private sector banks were also above the board. Private sector banks are also were equally inefficient, but only in terms of degree they were less compared to public sector banks. When the banking system was facing this kind of crisis, what was the response of the government? When banking system was facing this kind of crisis, the response of the government was to put more money into these public sector banks. To put more money into public sector banks. What is called capital infusion. To put more money into public sector bank, capital infusion. The taxpayers' money was used by the government of India to infuse new capital into public sector banks so that they could overcome the problems of ever increasing NPAs. This has continued from 2013 till 2021. At this point of time, if you look at the banking sector in India, yesterday itself, it had come in the newspapers that the NPAs of public sector banks this year are going to be the highest than at any point of time in the last 30 years of our liberalization process. It is said that the NPAs of public sector banks are going to be anywhere between 12 to 14% also, up from 7.5% last year. From 7.5%, it is said that the NPAs are going to be at least 12 to 12% conservatively, and it can be 14% also on the higher side. Of course, out of this, maximum amount of NPAs are with public sector banks. Why? Because on the one hand, Corona, on the other hand, of course, what we call it as crony capitalism, wherein the loans were given without any collateral securities. So the government appointed so many committees to reform the banking sector. Economic Survey had come out with the 4 R's to reform the banking sector. 4 R's. Recognition of the problem, then restructuring of banks, then recapitalization of banks, and then another R also that government of India had come out with. They said that they would like to implement these 4 R solution to reform the banking system in the country. But unfortunately, the government of India did not implement any other reforms. The government had come out with the Bank Boards Bureau. Please remember, this Bank Boards Bureau was also asked last year in your prelims. The objective of a Bank Boards Bureau was to depoliticize the appointment of directors to public sector banks. On the other hand, in the last 10 years, we have seen so many banks, both public sector and private sector banks, collapsing overnight. We have seen so many of them, collapsing overnight. We have, this people like, businessmen, crooked businessmen like Vijay Malaya or Nirav Modi, or for that matter, other businessmen ruthlessly exploiting the weaknesses in our banking system. The government did not take any structural measures to reform the banking system. On the other hand, government depended more on short-term measures in the form of recapitalization of these public sector banks. from 2014 till 2021, the government of India had spent lakhs of crores of rupees of public money to recapitalize these loss-making public sector banks. Yes, Ananya, I will talk about retrospective taxation later. Right now, we are looking at the banking system. I'll come to retrospective taxation later. Right? So the government, had come out with certain reforms. They had come out with Bank Boards Bureau, and they had, appointed a very credible, bureaucrat, a retired bureaucrat as the chairman of Bank Boards Bureau. The person, Vinod Roy, who was forefront in bringing about corruption in the previous UPA government. But unfortunately, this Bank Boards Bureau also, its performance was not up to the mark, as can be seen in the recent appointment of various public sector banks. Most of the directors who were appointed as the directors of these public sector banks were mostly from either bureaucracy or from mostly ruling political party. So the government still has failed to differentiate between the ownership and the management of public sector banks. On top of it, the major issue with our banking system is this performance of Reserve Bank of India. The Reserve Bank of India has simply failed to regulate the activities of these public sector banks as well as private commercial banks. It has failed to be an effective regulatory authority to control and direct the financial system. When the public sector banks were incurring a huge amount of NPS, simply Reserve Bank of India did not have a proper audit mechanism to find out about the financial status of the banks. And most of the banks also did not come out with their NPS in a more transparent manner. They always deliberately tried the real NPS, and they would come out with only a peripheral figure, manipulated figure. That is why we have seen in recent times so many banks collapsing overnight also. Reserve Bank of India, when Raghuram Rajan was there, he had come up with some stringent measures to control the banking system, but again those measures were not that much successful also. So, and that on top of it, we have these Basel norms also. On top of it, we have these Basel norms also. These Basel norms are what we call them as capital adequacy norms. So this banking sector always involves a very risky business. And what is the risk that we are talking about in the banking sector? A bank financial institution attracts deposits from the customers, and it gives loans to other sections of society, industrialists and everyone else. Now, a bank is taking a risk, right? It is taking a risk not on its own. It is taking the risk on behalf of the depositors. So someone has to protect the interests of depositors. And this has become a major issue after 2008 global financial crisis. What the public sector banks, investment banks and private banks in the United States of America have done, they have indiscriminately invested in the stock market of American financial system, and they have purchased so many financial instruments without looking at whether they are viable in the long term or not. The same thing happened with European central banks also. European banks also. Most of the European banks also had so much of faith in American financial system, they blindly invested in the shares there. And what happened? It resulted in creating artificial boom, which ultimately led to the collapse of stock markets, New York Stock Exchange. What happened in 1929 was repeated in 2008 also. What happened in 1929 was also repeated in 2008 also. So then that is when this IMF and World Bank had swung into action. They had spoken about what we call changing the global financial architecture. Stiglitz committee was appointed to give suggestions regarding the changing the global financial architecture, and they had come out with certain kind of reforms. In Switzerland, this Basel Accord was signed. Basel II norms were finalized after this 2008 financial crisis to protect the interests of depositors from this reckless speculation by the banks. Reckless speculation. What we call them as capital adequacy norms. And in Basel, we talk about Basel 1, Basel 2, and Basel 3 norms also. The basic objective here is to protect the interests of the depositors, from ineffective functioning of the financial system, especially the banking sector. Within India also, RBI has said that they would also follow these Basel norms to reduce the collapse of the financial system. Even though RBI has said that they have much more stringent capital adequacy norms compared to the Basel norms. In the Basel norms, they only talk about 8%. RBI has said that we have 9% of the total deposits as capital adequacy norms. In spite of the fact that we are talking about this 9%, still our banking sector, our banks are collapsing. Most of the private sector banks are also collapsing. As you know, in the last few years, so many of them have collapsed. This PMC, Punjab and Mumbai Cooperative Bank, it has collapsed. In recent times also, Lakshmi Vilas Bank, some of these banks also have collapsed, right? So what is the reason why they have collapsed? Why? Because RBI's failure, Reserve Bank of India's failure to properly regulate the activities of banks. RBI does not have what we call this forensic audit of the financial position of the banks. RBI auditors simply do not have the kind of experience to look into the entire banking system. Now what is happening is that because of this e-transactions, it also becomes difficult to know where the money is going into one account, how the money is being spent by other account also. So simply they do not have that kind of expertise also. On top of it, the government of India also has not taken any measures, as we have spoken about 4 different R's, to rectify the mistakes in the banking sector. But unfortunately, the government of India also has not taken what we call concrete steps to reform our banking sector. If at all we have to talk about reforming our banking sector, what are the important reforms that we can talk about? First and foremost, the government has to separate clearly the ownership from management of public sector banks. You have to separate the ownership from management of public sector banks. Government can retain the ownership of public sector banks. Second, most important reform is privatizing the public sector banks. As we study all the time, government has no business to be in business. The government cannot do business properly. Privatizing the public sector banks. Third, the most important reform the government has to implement is Reserve Bank of India. We must accept that is a failure to regulate our financial system, especially the banking system. So the government must come out with another regulatory authority, especially only for the banking system, consisting of the experts in that particular field. That is what the government has to do. And fourth, the government also has to do something for these NPAs, non-performing assets. As the government had come out with in recent times, IBC, Insolvency and Bankruptcy Code. As Economic Survey this year has itself accepted, this IBC has not been as successful as it should have been because of various legal and other administrative bottlenecks. But at least it has started a good precedent wherein those who are incurring losses, those whose assets have been transformed into NPS, are willing to negotiate with the banks and also to come clean with their accounts. So this IBC should be implemented in a more effective manner. Next, recently the government of India had come out with this Depository Insurance scheme. The government has said that if any bank collapses within a stipulated time period of 3 to 4 months, the government is willing to redeposit the money into the accounts of less than 5 lakh rupees in that account, deposit insurance. And in recent times, the government also had spoken about this bad bank also. I think this bad bank requires a little bit of explanation. I think we can do that bad bank also. We can talk about it tomorrow in the class. This bad bank also. This concept of bad bank, right? Had been brought up by the government in the recent budget also, right? That also recently the government had come out with as a solution to the banking sector problems in the country. And what are the other solutions in the banking sector? There must be more transparency. The government must strictly adhere to the Basel norms. Basel norms. Tomorrow also we will look at those Basel norms also. Right. So these are all the things that we have to discuss as part of the banking sector. And I thought that we can do today inflation also, but the problem is that it is already time. So what we can do is that tomorrow, we can continue with other reforms in the banking sector, and also we will go to inflation. Other reforms in the banking sector, and we will also go to inflation. That is what we can be discussing tomorrow as part of our classes. Meanwhile, what you can do is you can, if you have any doubts, you can always come up with your doubts. And again, we will focus more on analysis only. We will focus more on analysis. On your part, what I would suggest is that please go through all these different types of banks which UPSC is asking, which UPSC is asking from your in your prelims, like regional rural banks, National Bank for Agriculture and Rural Development, then these lead bank scheme of the government of India, then cooperative credit societies, district cooperative credit societies, and please go through all of them, because you don't want to lose a single question also if they are asked from these topics. It is very easy to get right answers for these questions, right? So make sure that you are going through all of them, because they are all completely factual aspects which should not be difficult for you at all. So this is it for today. As I said, if you have any doubts, you can always come up with your doubts tomorrow. Tomorrow we will continue with this banking sector, and we'll do inflation, and we'll also go to international trade also tomorrow, right? Till then, take care of yourself, right? Best of luck.